Securities markets. As our opening case illustrates, mutual funds trading is a risky, big stake industry featuring rapid buying and selling in the financial marketplace. The markets for various other kinds of financial instruments too thrive on similarly fast paced exchanges among investors. Among these instruments, stocks and bonds are known as securities because they represent secured and asset based claims on the part of the investors. In other words, holders of stocks and bonds have a stake in the business that issued them. As we saw earlier, stockholders have claims on some of the corporation's assets and a say in how the company is run because each share of a stock represents part of our ownership. In contrast, bonds represent strictly financial claims for money owed to holders by a company. Companies sell bonds to raise long term funds. The markets in which stocks and bonds are sold are called securities markets. Primary and secondary securities markets. Primary securities markets and secondary securities markets. In primary securities markets, new stocks, bonds are bought and sold by firms and governments. Sometimes new securities are sold to single buyers and small groups of buyers. These private placements are desirable because they allow issuers to keep their plans confidential. In 2003, more than 500 billion in new private placements were purchased in the United States by the large pension funds and other institutions that privately negotiate prices with the sellers. Because private placement cannot be resold in open market, the buyers generally demand higher returns from the issuers. Investment banking. Most new stocks and some bonds are sold on the wider public market to bring a new security to market. The issuing firm must get approval from the Securities and Exchange Commission (SEC), the government agency that regulates security markets. It also needs services of investment banks, a financial institution that specializes in issuing and reselling new securities. Such investment banking firms as Merrill Lynch and Morgan Stanley provide three important services. Number one, they advise companies on the timing and financial terms of the new issues. Number two, they underwrite, that is, buy new securities, thus bearing some of the risk of issuing them. Number three, they create distribution networks for moving new securities through groups of other banks and brokers into the hands of individual investors. I beg your pardon, please. In year 2003, US investment banks brought to the market nearly $100 billion corporate stocks to $600 billion in new corporate bonds. New securities, however, represent only a minute portion of traded securities. Existing stocks and bonds are sold in secondary securities market, which is handled by such familiar bodies as the New York Stock Exchange. We'll discuss it later in the same chapter. Stocks. Each year, financial managers with millions of individual investors buy and sell the stocks of thousands of companies. This widespread ownership has become possible because of the availability of different types of stocks and because the markets have been established that enable the individuals to conveniently buy and sell them. We focus on the value of common stock and preferred stocks as securities. We also describe the stock exchange on which they are bought and sold. Common stocks. Individual and other companies purchase a firm's common stock in the hope that it will increase in value, provide dividend income, or both. But how is the value of a common stock determined? Stock values are expressed in three different ways: as par, as market, as book value. We'll discuss all of them in detail in the next video.